Hi, I'm Anand Subramanian, Managing Director at Macquarie Capital. I'm joined by Ravi Viswanathan, Founder and Managing Partner of NewView Capital. Ravi, it's great to see you again. You and I sat in these chairs 12 months ago.
Right.
So welcome back.
Thank you, it's great to be back, Anand.
Now, if I think back, Ravi, just 12 months ago when you and I sat here, NewView Capital was just a couple of months old. You had just spun out from NEA.
Right.
It was really a transformational model in the venture capital industry. Maybe start off by telling us, what are two or three things that you've learned in the last 12 months just from being an independent platform?
Probably the two biggest learnings for us is just our emphasis and our ability to move quickly and also build a culture. So the moving quickly piece, it really is a startup. So I was at NEA, New Enterprise Associates, for 15 years, a large venture firm, global venture firm, bi-coastal venture firm, to basically move from there into really a startup. It was an 8-person firm in the Bay Area. Just that has been a real learning and a real transformation, and it's been wonderful. It's been wonderful to see just the development of the folks. We have operating partners, we have principals, associates, just how they've grown. Also the fact that with that platform and with such a tight-knit team, we're able to move more quickly than I had thought, which has been really great, and that's really important in this market environment, so that's one. The second is the same analogy, is just the culture. So when you start out with a small team, any culture that you incorporate there, it's going to be really important to keep that culture. So it's really team-based, working together, making sure we spend time, really get to know each other, trust each other. We have a values statement that we talk about, we have offsite. So those two have been kind of the biggest learnings for me.
I think the whole premise, or one of the core premises of NewView is around providing patient capital to great companies who are simply staying private longer, where the venture model is great during their initial years of existence, but now they need a different kind of partner. What else are you seeing and that you'll add to your model maybe in the next 2 to 3 years, taking advantage of that opportunity? And probably just given our current market environment, how does that shape your thinking for the next couple of years?
Well, I would say, our model is pretty unique to begin with. So, we're a registered advisor. And so that's a nuance, and very few venture firms are registered advisors. That means that we can invest into companies on a primary basis. It also means we can invest on a secondary basis. And that was also been a pretty big learning, just to get back to your learnings question, that has been unique for us, that we can invest, and we've done 5 new deals. There's been a lot of primary capital as well as secondary capital. Primary capital defined as capital going on the balance sheet of the company. Those two vectors, there's a tremendous amount of runway in front of us. Also, as we did with the NEA deal, where we spun out a portfolio of companies from NEA, we think there's a lot of opportunity to do similar types of deals and similar types of situations with a lot of other GPs and venture firms. The market, look, it's an incredibly volatile market. You have the coronavirus fears, election year, and I think in these volatile times, I've had the distinct fortune or misfortune, depending on how you look at it, of having lived through 2 pretty significant downturns in the 20 years I've been a venture capitalist, 01 and then 08, 09, obviously. I think in these times is really, the phrase hunker down comes to mind, really focus on being efficient with your capital, making sure that the companies don't die because of lack of capital, but the capital you have, make sure it lasts, and really focusing and executing. That's been a really big mantra that we talk about internally as well as to our companies.
And as market conditions, let's say they remain equally volatile, how do you guide your CEOs in terms of being on the front foot with either acquisition of weaker competitors or entering into markets where there could be opportunity?
For sure, I think that's absolutely a great point. I think that the first thing we talk about is, I mentioned efficient growth. It's really efficient growth versus pure growth. So our firm is much more efficient growth. And what does that mean? Pure growth is and pure growth has been the case for the last 5 to 10 years, which is capital is freely flowing and you grow at all costs or at high costs. Efficient growth really looks at every dollar that you invest, what are you getting out? And how do you think about that as a resource allocation framework? So a lot of it is preaching efficient growth. And once you do that, one of my most valued CEOs told me years ago that in these turbulent, volatile down markets, if you really have your wits about you and you're much more efficient with your capital and you focus and execute, it's actually an opportunity for you to gain market share at the expense of a lot of your peers who probably are not thinking that way. So what does that mean? It's obviously just doing your run-of-the-mill business and just doing it better and being much more efficient, being much more mindful of metrics, and then having the cash last. That's one. The second is, to your point, I actually do think that there's opportunities. So a lot of our companies are really consolidating. They're becoming the consolidators in their markets and buying smaller companies, subscale assets. And for those, you can actually usually get them at accretive prices. And so there's several in our companies that are actually thinking about the inorganic path to scale. So most companies really, in startup world, it's really about organic scale. It's like, you invest and you grow, and you don't really think about acquiring other businesses. A lot more of our companies are starting to think about that, and I think you'll see that much more, certainly in the next few years.
What would you tell them about things to know, things to stay away from?
Yeah, I mean, there's tons of lessons learned, and this consumed most of 2018 for me, as you know. I would say that, look, there's well over $1 trillion of private market valuations out there, right? So it's a massive amount. We injected a little bit of liquidity for the LPs. Our deal was, $1 billion, so it was a drop in the bucket, frankly. I do think that as firms evolve and they continue to raise capital and they continue to deploy capital and increase their portfolios, as these companies stay private longer, we just thought when we were in NEA, we thought of this as really an active portfolio management tool, a framework to really think about, okay, we have a large portfolio. There's a lot of companies that we're focused on. There's some that maybe are in older funds, or maybe the partner that had led the deal had left, and there's a better way for it to be monitored and managed. So we carved out this portfolio and started NewView. We've had conversations in the last year. That's another thing that's been really interesting with 30, 40 venture firms thinking about, all right, how do we think about doing this? Why did you do it? So I do think that is going to become more mainstream. It may take 5 years, it may take longer. If you just look at our brethren in the private equity world, right? I mean, they do that all the time. They just call it something different. They call it sponsor-to-sponsor deals.
Yeah.
It's easier for them to do because they own their assets, they own their company, so they can decide tomorrow we're going to sell this company. We're all minority shareholders. It's a little bit tougher. Having said that, I do think that you're seeing more and more folks think about, okay, we've had an older fund, or some of these companies are quality companies, but there may be a better framework to have someone else manage it. I do think that another very important lesson, because this we went through when I was at NEA, is what is the implications or repercussions, if any, in this? And it really started with the companies. You want to make sure that they appreciate what you're doing and it doesn't feel like you're abandoning them. And so, when we went through this, we spent a lot of time building relationships, and even throughout last year, continuing to build those relationships with these companies. And it's been pretty universal, their enthusiastic support, because now they have a fresh set of capital, follow-on capital, new folks to help really manage the company for the next phase of their growth. So when we did it a year and a half ago, there was a stigma that we had to overcome. I actually think now the market is changing. It's less of a stigma. As you'd mentioned, Insight doing it, there's been a couple other firms that have done it, and we welcome that, we embrace that. We think that's really good for the industry. It's also good for the limited partners who continue to make more increasing commitments to these venture firms. You need to make sure that they are seeing liquidity on the other side, right? Otherwise, our model actually doesn't work.
Right.
And traditionally, it's been IPO or M&A. I do think that some of these financial type deals, sponsor to sponsor if you call it in the venture side, just gives one more vector for these LPs to see liquidity and GPs and venture firms to kind of refresh their portfolios.
Well, thanks again for your time.
Absolutely.
I look forward to seeing you here in version 3.0 in 2021.
Awesome. Thanks, Anand.
Thanks.
Thank you.